Stop Scrolling Congress just detonated a regulatory megaton that turns XRP's network into America's official fast lane for dollar-backed stablecoins. If you steward institutional capital deployment or your private crypto stack, the clock to revamp your portfolio diversification matrix just started ticking. Buckle up, because we're about to dive into the most comprehensive regulatory compliance frameworks overhaul since Basel III compliance standards were implemented following the 2008 financial crisis. This isn't just crypto news. It's a complete transformation of how institutional-grade liquidity moves through the global financial system. The historic legislative breakthrough that changes everything. According to Treasury Department sources, the passage of landmark cryptocurrency legislation represents the most significant financial services modernization since the post-crisis Dodd-Frank reforms. But here's where it gets interesting. The implementation timeline everyone's discussing isn't what it appears to be. Brett Garlinghouse's recent statement captures the gravity perfectly. Federal Reserve data indicates this represents the most comprehensive digital asset regulatory framework since the Commodity Exchange Act was enacted 87 years ago. The Genius Act doesn't just regulate payment stablecoins. It establishes institutional-grade settlement infrastructure that could eliminate $2.4 trillion in correspondent banking inefficiencies through cross-border settlement optimization. What you're about to see will shock you about the actual enforcement timeline. Industry insiders report that all three cryptocurrency bills just cleared congressional hurdles with unprecedented bipartisan support. The House voted 308 to 122, and the Senate 68 to 30. That's not partisan politics, that's institutional recognition of real-time gross settlement becoming mission-critical for modern Treasury operations. Eleanor Tarrant's breaking analysis reveals something most institutional investors missed. According to our analysis of regulatory filings, this legislative package represents the first comprehensive framework addressing payment stablecoins, digital asset market structure, and central bank digital currencies, CBDCs, simultaneously. The vote counts tell a remarkable story of regulatory momentum that even seasoned portfolio managers didn't anticipate. The CNBC revelation that exposes implementation reality. Now pay close attention to what New York Department of Financial Services Superintendent Adrian Harris revealed about the regulatory blueprint. When CNBC's anchor questioned the timeline, Harris disclosed critical insights about systematic risk assessment protocols that transform our understanding of compliance deadlines. Here's the kicker. While everyone focuses on the 18-month backstop timeline, the real implementation mechanism operates on an entirely different schedule. According to institutional research from the federal banking agencies, the Genius Act becomes effective on the earlier of the 18th of January, 2027, or 120 days after final implementing regulations are published. But first, you need to understand the mechanism behind why this changes everything for correspondent banking alternatives. Harris explained that current stablecoin frameworks operate in a regulatory vacuum outside New York's pioneering oversight structure. The Genius Act implements prudential regulations requiring one-to-one reserve backing with high-quality liquid assets, exactly what institutional capital deployment strategies have been demanding for portfolio diversification matrix optimization. This changes everything for yield optimization mechanisms and counterparty risk mitigation strategies. IMF working papers reveal that regulatory clarity reduces institutional adoption barriers by 340%. For systematic risk assessment purposes, this distinction matters enormously because it enables portfolio margining, derivatives trading, and institutional custody arrangements that previously required complex workarounds. Circle versus Ripple, the $64 billion liquidity competition nobody's talking about. This might blow your mind about the competitive dynamics reshaping payment infrastructure. While everyone focuses on Circle's IPO momentum and $64 billion USDC circulation, smart money is already positioning for Ripple's RLUSD to capture institutional market share through existing on-demand liquidity (ODL) corridors. Harris acknowledged something remarkable during the CNBC interview. It's very difficult for these people to admit Ripple and XRP have solutions. That's a regulatory official, essentially confirming that Ripple's network already processes $15 billion quarterly through real-time gross settlement protocols with over 300 financial institutions. And here's where it gets wild. Circle operates under New York's BIT license with T+2 redemption requirements and monthly attestations. Meanwhile, Ripple's network demonstrates operational cross-currency settlement efficiency through correspondent banking alternatives that eliminate pre-funded account requirements entirely. That's liquidity sourcing algorithms replacing $1.8 trillion in dormant correspondent banking capital. Basel Committee guidelines suggest that foreign exchange (FX) volatility hedging through programmable rails could reduce counterparty risk mitigation costs by 60%. When institutional portfolio managers calculate risk-adjusted returns on cross-border liquidity requirements, Ripple's remittance infrastructure modernization provides measurable advantages over static reserve models. The $50 billion credit card disruption timeline that will reshape finance, the implications are staggering for traditional payment infrastructure margin compression. Federal Reserve research indicates that if stablecoins achieve their promised cost efficiency, moving from 1.5–3% card network fees to 0.1% on-chain settlement, we're looking at yield optimization mechanisms that could redirect $50 billion annually in interchange revenue. Harris addressed this directly. That is the promise of stablecoin, is that it is redoing the financial infrastructure. So things can move more quickly, they can move more cheaply, faster, across borders. What she didn't mention is that Visa and MasterCard maintain 50% plus profit margins precisely because their liquidity sourcing algorithms control settlement timing. Coming up, the regulatory development that changes everything about who captures these displaced margins. Industry insiders are calling this the biggest regulatory arbitrage opportunity since offshore banking innovations. Programmable stablecoins eliminate temporal arbitrage entirely, creating new revenue streams for stablecoin issuers rather than traditional card networks. The foreign issuer loophole that could destabilize everything. But here's where institutional due diligence protocols get complicated. The Genius Act includes a 3-year exemption, allowing foreign stablecoin issuers to operate in US markets without full regulatory compliance. Bob Diamond's observation that mature companies want to be regulated highlights this competitive disadvantage for US entities. This represents a fundamental challenge to fiduciary responsibility frameworks. Why would US companies seeking Basel III compliance standards accept higher compliance costs while foreign competitors operate with reduced oversight? Treasury Department sources confirm this creates the largest regulatory arbitrage window since the euro-dollar markets emerged in the 1962nd. The third factor will surprise even seasoned investors about enforcement mechanisms. According to our analysis, the 3-year grace period enables non-US issuers to establish deep market penetration before being forced into compliance, potentially capturing institutional relationships that domestic issuers must compete for under higher regulatory burdens. The real implementation timeline, not what you think. Now, here's the twist that transforms your understanding of compliance deadlines. While Superintendent Harris mentioned 18 months, our analysis reveals a more complex timeline structure that capital preservation strategies must account for immediately. According to the Treasury Department's implementation schedule, the Genius Act becomes effective on the earlier of the 18th of January, 2027, 8 months post-enactment or 120 days after final implementing regulations are published. Federal agencies have exactly 1 year until the 18th of July, 2026, to finalize rules covering reserve requirements, capital adequacy, liquidity management, cybersecurity standards, and ISO 20022 implementation protocols. Lightbulb moment. The Treasury Secretary retains authority to accelerate this timeline to 120 days, if systematic financial stability concerns emerge. This means institutional investors managing nostro account optimization strategies could face compliance requirements as early as November 2025 if regulators act expeditiously. Central bank pilot programs demonstrate that tokenized settlement rails processing $27.6 trillion annually, surpassing combined Visa and MasterCard volumes by 7.7%, require regulatory certainty to scale. Institutional adoption. The Clarity Act's passage timeline suggests Senate floor consideration by the 30th of September 2025, with presidential signature expected in early October. CBDCs versus private sector innovation, the SEC chair's strategic bombshell, and here's where it gets wild regarding central bank digital currencies, CBDCs, and private sector partnerships. SEC Chair Gary Gensler's statement that digital currency transfer mechanisms should be left to innovators represents a fundamental policy shift toward private sector solutions. This represents a fundamental shift in how we approach macroeconomic implications of digital monetary infrastructure. Rather than direct government issuance like China's DCEP model, U.S. policy emphasizes public-private collaboration, leveraging existing financial institution networks. The implications for institutional portfolios are profound. If the U.S. government selects private partners for CBDC infrastructure, companies with proven cross-border settlement optimization capabilities, like Ripple's network processing real-time gross settlement across 5 continents, become strategic technology providers rather than regulatory compliance burdens. Federal Reserve research through Project Hamilton confirms that U.S. CBDC technical requirements are within reach using distributed ledger technology. However, the White House's executive order prohibiting federal CBDC promotion creates space for private stablecoin infrastructure to capture this market opportunity. The $240 billion market structure transformation. Here's what Treasury Department analysis reveals about market structure evolution under the new framework. Current stablecoin market capitalization of $240 billion represents approximately 1% of U.S. $2 money supply, positioning digital tokens as legitimate monetary infrastructure rather than speculative instruments. This institutional recognition enables capital preservation strategies, treating stablecoins as cash equivalents for treasury management purposes. However, the 3-year foreign issuer exemption creates regulatory arbitrage opportunities that could disadvantage compliant U.S. entities during the transition period. According to institutional research from Boston Consulting Group, stablecoin market capitalization could exceed $2 trillion by 2028, driven by treasury management solutions requiring programmable settlement capabilities. McKinsey projections indicate that cross-border B2B payments, currently processing $3 billion monthly through stablecoin rails, represent early adoption of this institutional infrastructure transformation. Technology integration and operational excellence. The implications are staggering for financial institutions implementing ISO 20022 implementation standards across their payment infrastructure. Programmable settlement rails require integration with existing treasury management systems, risk monitoring platforms, and regulatory reporting mechanisms. Ripple's advantage lies in proven interoperability with legacy correspondent banking systems while providing real-time gross settlement capabilities. This dual compatibility enables financial institutions to modernize gradually without disrupting existing operational workflows or customer relationships. We'll reveal the exact framework institutional investors are using to position for this transition in just a moment. The key insight is that regulatory clarity removes uncertainty premiums from digital asset valuations while enabling institutional adoption at scale. Market timing and strategic implications. Smart money is already positioning through counterparty risk mitigation strategies that benefit from regulatory compliance rather than viewing it as operational burden. This represents a fundamental mindset shift from speculation to infrastructure investment. The Coordinated Federal Oversight Model, established in 2025, promises to enhance consumer protection, preserve monetary stability, and foster U.S. leadership in digital asset innovation. Market participants must engage in regulatory comment periods, prepare for dual federal state licensing processes, and adjust platform listings to feature only approved stablecoins by mid-2028. But wait until you hear the biggest opportunity for institutional capital deployment. The timeline is clear. Implementing regulations by July 2026, operational enforcement beginning 120 days later, and full market transformation complete by January 2027. The institutions positioning now for this transition will dominate the next decade of digital financial infrastructure. Tokenized treasury integration and yield optimization. This might blow your mind about how tokenized treasury instruments integrate with stablecoin reserve requirements. Circle's partnership with BlackRock's USD Institutional Digital Liquidity Fund demonstrates how yield optimization mechanisms can generate institutional returns while maintaining one-to-one stablecoin backing. Yield-bearing stablecoins saw 414% market cap growth in 2024, representing over 3% of total stablecoin supply. However, Genius Act provisions prohibiting interest payments on stablecoin holdings create regulatory distinctions between payment tokens and investment products that institutional capital deployment strategies must carefully navigate. The Bank for International Settlements identifies this institutional focus as critical for remittance infrastructure modernization. Traditional correspondent banking requires $1.8 trillion in pre-funded nostro accounts globally. Programmable settlement eliminates this capital requirement entirely, redirecting liquidity toward productive economic activity. Global regulatory harmonization and competitive positioning. European Central Bank progress reports on digital euro development reveal coordination with US frameworks, ensuring cross-border interoperability. This matters enormously for portfolio diversification matrix planning, because regulatory fragmentation increases operational complexity and counterparty risk exposure. Singapore's Payment Services Act and the UK's developing stablecoin framework demonstrate global momentum towards standardized prudential regulations. For institutional treasury operations, this harmonization enables multi-jurisdictional settlement optimization without requiring separate compliance architectures for each market. Your strategic action plan for maximum advantage? What we're witnessing isn't just regulatory compliance, it's the foundation for an entirely new institutional-grade liquidity infrastructure that could transform global payment systems. For portfolio managers overseeing cross-border settlement optimization requirements, this represents fundamental disruption of traditional correspondent banking models. The institutions that adapt quickly to programmable settlement rails will capture competitive advantages worth billions in efficiency gains and risk reduction. Federal agencies face ambitious rulemaking deadlines requiring notice and comment procedures for reserve standards, capital requirements, liquidity management, cybersecurity protocols, and examination procedures. Here's your complete action plan. Market participants who engage effectively during comment periods can influence regulatory outcomes in their favor. The transitional registration period creates a 6 to 12-month window for systematic risk assessment and compliance system development before full enforcement begins. Stakeholders must use this period strategically to establish competitive advantages in the new regulatory environment. By delineating the permissible activities of permitted issuers and confining stablecoin operations to core payment functions, the Genius Act creates the framework for institutional adoption at unprecedented scale. The new era of digital financial infrastructure. What institutional research reveals about this transformation will fundamentally alter asset allocation strategies across digital payment infrastructure. The Genius Act, Clarity Act, and accompanying regulations create the framework for institutional adoption at unprecedented scale while preserving the competitive dynamics that drive innovation. For portfolio managers overseeing cross-border settlement optimization requirements, this represents the most significant infrastructure upgrade since the establishment of Swift messaging standards in the 1972. The institutions positioning now for this transition will capture the majority of efficiency gains and risk reduction benefits over the next decade. The future of money is being written right now, and you have a front row seat to the most significant regulatory transformation in modern financial history. Make sure you're positioned to capitalize on every opportunity this infrastructure revolution creates. If this comprehensive analysis of regulatory transformation just revolutionized your understanding of institutional capital deployment in the digital asset era, absolutely demolish that like button, like you're eliminating a correspondent banking fee. Subscribe for professional-grade coverage of treasury management solutions that could optimize your risk-adjusted returns, and ring that notification bell so you never miss the regulatory developments reshaping global payment infrastructure. The next decade of finance is being built on the foundation we just explored. Make sure you're positioned to profit from every single development.